The barrier is gone. For months, the entire financial world insisted that $65 was the ceiling, the line in the sand. They said the banks would defend it with every paper contract they could throw at the market. But today, Wednesday, December 17th, 2025, the market voted, and the market chose violence. We didn't just tap $65. We blasted through it. Earlier today, silver exploded upward and printed $66.50. Right now, as I'm speaking to you, price has eased back a bit and is hovering around $65.80. And I know exactly what you're feeling. You're staring at that pullback, watching the move from $66.50 down to $65.80, and you can feel the fear creeping in. You're asking yourself, was that it? Was that the top? Is this another fake out? Stop. Listen closely. What we're witnessing isn't a crash. It isn't failure. It's one of the most important behaviors a market can show after a breakout. A retest, the moment when old resistance is tested again to see if it can become new support. Investopedia. In this deep dive market update, we're going to dissect the anatomy of this breakout. We're going to explain why price shot to $66.50 so fast. We're going to break down the gamma squeeze mechanism that forced banks and market makers to buy whether they wanted to or not. And most importantly, I'm going to show you why this pullback to $65.80 is actually healthy. If we had kept going straight up in a vertical line, we would have been vulnerable to a hard snapback. By pulling back and testing the floor, the market is building a launch pad for the next leg higher. The wall at $65 has fallen, but now we have to defend the rubble. To understand why silver seemed to teleport from $64 to $66.50 this morning, you have to understand the plumbing under the market. You have to understand gamma. Gamma is an options term technically. It's the rate at which delta changes as the underlying price moves, meaning the risk profile of an options position can shift faster and faster as price rises. Option alpha. Think of the market maker like the house in a casino. They sold millions of ounces worth of call options at the $65 strike bets that silver would rise. While silver stayed below $65, the house was comfortable. Those calls were essentially worthless, but the instant silver crossed $65, the house's position flipped from comfortable to dangerous, and the danger didn't increase linearly. It accelerated. When price hit around $65.10, the market makers' risk alarms started screaming. To keep the bank from bleeding billions, the hedging systems kicked in automatically and began buying silver futures not because they suddenly loved silver, but because they had to hedge their exposure. And here's the trap. Their buying pushed the price up to around $65.30, which made their hedging requirement even larger, which forced them to buy more, which shoved price up towards $66. That's the gamma squeeze, a feedback loop where dealer hedging adds fuel to the rally and can drive explosive mechanical price moves. Schwab brokerage, +1. It's the same kind of mechanical loop people point to when they talk about the GameStop insanity back in 2021. It's not about fundamentals. It's not about supply and demand in that moment. It's math and positioning, pure mechanics. That spike to $66.50 was the sound of algorithmic panic buying as the system tried to cover exposure. It was a vacuum move, not enough sellers, just desperate machines competing to buy. So why did it stop? Why did we slide back to $65.80? Because humans stepped in. Traders saw that vertical line and took profits. The gamma-driven burst exhausted itself. And now we're drifting back toward reality, but the damage is already done. $65 was breached. The psychological barrier snapped, and the market makers are on edge now, because they've seen the beast can bleed. Now let's talk about the price right here, $65.80. To an amateur, a drop from $66.50 to $65.80 looks like weakness. To a professional, it looks like confirmation, because markets often come back to test the breakout level. There's a widely used principle in technical analysis. Old resistance can become new support after a breakout, and the retest is where that story gets proven or disproven. Investopedia, +1. For months, $65 was a concrete roof every time we touched it. We got shoved back down. Today, we punched through that roof, and now we're standing on top of it, stomping on it, checking whether it's solid enough to hold our weight. This pullback to $65.80 is the market's way of testing the new floor. Here's what we need next. We need buyers to step in here, and we need price to hold above $65. If we stay above $65 through the rest of the day, that's confirmation the breakout was real. It tells the world that $65 is no longer the price to sell, it's the price to buy. But I have to warn you, this is where we play it safe. If price drops back below $65, if we close the day down at $64, that's a classic fake out. It means the breakout failed, sellers still control the tape, and fake outs often lead to violent downside. So $65.80 is a battleground. We're in a buffer zone about 80 cents of breathing room above the danger line. Don't celebrate yet. We need the daily close. We need proof the old roof can truly support the new price. And remember the whale we talked about, the mysterious buyer who absorbed $650 million worth of silver around $63? Everyone kept asking, where did they go? Did they sell into $66.50? Did they dump on retail? I've been watching the order book all morning, and I can tell you this, the whale is still here. When price fell from $66.50 down towards $65.80, massive block orders showed up on the bid. Someone stepped in around $65.75 and basically said, I'll take it. That tells us something critical. Smart money now thinks $65 is cheap. Last week they thought $63 was cheap, now they're willing to pay up to defend the breakout. This is not the behavior of someone desperate to cash out. Speculators sell into strength. This buyer is supporting weakness, building a floor to keep the market from collapsing back under $65. Why would they do that? Because they know what comes next. They know if $65 holds, the next target isn't $66, it's $70, and then $85. They're building a base camp. They're securing territory before the next advance. So when you see $65.80 on your screen, don't interpret it as a loss. See it as consolidation. See it as the big players reloading. The gamma squeeze was the spark. The retest is the fuel. But the fire, the real fire, comes from the short sellers. Commercial banks like J.P.Morgan and Bank of America have been short silver for years, selling paper contracts to suppress the price. But at $66.50, their losses became catastrophic. In Part 2, we're going to examine bank capitulation. We're going to explore the rumor, unconfirmed but persistent, that a major commercial bank closed a big short position this morning. We're going to explain why short covering is rocket fuel for price. And we're going to calculate how much money the banks lost in the last 4 hours. The breakout already happened. Now the cover panic begins. Stay tuned for Part 2 because we're about to count the losses. If you're just joining us, let's reset the board. The breakout is in motion. Silver smashed through the $65 ceiling, tagged $66.50, and is now consolidating around $65.80. The gamma squeeze, the algorithmic buying frenzy, lit the match. But a match isn't a wildfire. To burn down a forest, you need fuel. And in silver, the fuel is not the retail investor. It's not the solar company. The fuel is the commercial short seller. For roughly 40 years, bullion banks played a brutally profitable game. Sell paper when price is high, buy it back when price is low, and act like a governor on an engine setting the speed limit at $30 or $50. But today that governor cracked when we crossed $65. The math shifted from profitable to catastrophic. To understand the panic unfolding in New York, you have to look at the commitments of traders. Report, a weekly report from the U.S. regulator, that breaks down who holds long and short positions. CFTC.gov+1. Commercials code for the bullion banks are historically net short. That means they've sold more paper silver than they've bought. According to the latest data we're discussing here, their net short position is roughly 80,000 contracts. One contract equals 5,000 troy ounces. Barchart.com+1. Do the math. 80,000 times 5,000 equals 400 million ounces. That's 400 million ounces they've effectively promised to deliver metal they do not own because they expected to buy it back cheaper. They sold it at $50. They sold it at $55. Today, price is $65.80. Every one of those contracts is underwater. This is what a trap looks like. If you're long, the worst case is price goes to zero. If you're short, the risk is infinite. If silver runs to $100 or $500, the short owes that move. There's no ceiling on the pain. So at $66.50, bank risk managers woke up, looked at exposure, looked at empty vaults, and realized they were sitting on a potential loss that could dwarf quarterly earnings. That forces a behavior change. Normally, when silver rises, banks add shorts to cap the price. But today, they can't. Credit lines are stretched. Instead of adding shorts, they have to close them. And how do you close a short? You buy. You become a forced buyer. You compete with Tesla. You compete with the whale. You compete with the retail investor. You don't care about price. You care about escape. That creates a super bid under the market, like a trampoline beneath the tape. Every dip gets absorbed because a bank somewhere needs to cover a few thousand contracts. This is why $65.80 is holding. The banks are eating their own tail. Now quantify the pain. Because markets are driven by pain. In this setup, for every $1 silver rises, the commercial short position loses roughly $400 million. Since the breakout began around $60, silver is up almost $6. 6 times $400 million equals $2.4 billion. That's $2.4 billion in losses on paper. But it's worse, because that number assumes they can cover at the current price. They can't. If they tried to buy back 400 million ounces right now, price wouldn't politely sit at $65. It could leap toward $100 in a heartbeat. That's slippage. The act of exiting makes the exit more expensive. So the real loss might not be $2 billion. It could be $10 billion or $20 billion, a black hole on the balance sheet. This is why $65 was the Maginot Line. Above it, losses become visible. Above it, CEOs get calls. Above it, regulators start asking whether someone is solvent. We are watching a slow-motion car crash. The banks are trying to exit gracefully, slowly, quietly, without spiking price. But the whale isn't letting them. The whale is absorbing supply, forcing the banks to bid higher. This is the heart of a short squeeze. Not just price rising, but wealth transferring from the entities that suppressed price to the entities that broke the suppression. Every dollar higher is $400 million moving from Wall Street to Main Street. So how do we know the banks are capitulating instead of just reloading for another smash? We watch open interest, the total number of outstanding contracts, CME Group, +1. In a normal market, price rises and open interest rises. In a true short squeeze, price rises while open interest falls because shorts are closing and leaving the casino. Later today, when the exchange releases preliminary Wednesday data, that number matters. If price is around $65.80 and open interest drops sharply, it's the smoking gun. It confirms the rally was powered by banks exiting. That is one of the most bullish signals possible, because it means the permanent sellers are disappearing. Once shorts are closed, who is left to sell? Nobody. Selling pressure evaporates, and price is free to float toward its natural level. But I have to warn you again. Banks are wounded animals. Before they fully capitulate, they might try one last Hail Mary. They might dump a massive wave of paper at 2 a.m. tonight to trigger panic selling, one final attempt to scare you into giving them liquidity so they can escape. If you see a sudden flash down to $64, don't assume the rally is over. Assume it's the death throes of the short seller. Assume it's a final shakeout. Unless we break below $61.50, the trend remains intact. Capitulation is a process, not a single candle. And while the banks play paper games, the physical world is running out of time. The spike to $66.50 wasn't only gamma or short covering, it was also desperation. Real industrial desperation. In Part 3, we're going to leave Wall Street and walk onto Main Street. We're going to expose the physical disconnect. We're going to talk about reports that major industrial users are paying $70 per ounce just to secure metal. We're going to look at the dealer market, where premiums are climbing even as spot consolidates. The paper market is breaking. The physical market is taking over. Don't go anywhere. We need to talk about the $70 secret. If all you're doing is watching the ticker on CNBC, you're missing the real story. You see $65.80 and you think that's the value of silver. It isn't. It's the value of a paper promise to deliver silver in New York next month. But if you step into the real world, if you call a refiner, if you try to buy a monster box of Eagles, you enter a different reality. The disconnect between the screen price and the street price is widening. While banks fight to keep paper under $66, major industrial users are quietly paying $70 or more just to guarantee delivery. That's the shadow price, the price Samsung pays to keep a factory running. The price the U.S. Mint pays to secure blanks, and in the long run, it's the only price that matters. The paper market is a distorted mirror. The physical market is the object. And right now, the object is moving faster than its reflection. Why would an industrial company pay $70 when the screen says $65.80? Reliability. Imagine you run a solar panel plant. Your assembly line costs $1 million an hour to operate. If you run out of silver paste, the line stops and you lose millions. You call your supplier. They say, "We can get you metal at the paper price of $65.80, but you'll wait 3 weeks. Or you can pay $70 and we'll ship from emergency reserve today." You don't hesitate, you pay $70 because the premium is nothing compared to the cost of shutting down production. We're hearing reports of this kind of premium buying spreading across the supply chain. Electronics manufacturers are bypassing exchanges and going directly to mines and refiners, offering cash bonuses to jump the line. That creates a shadow market. The volume moves off exchange. It doesn't show up on COMEX volume bars. It doesn't immediately force spot higher, but it drains physical inventory at an alarming rate, while banks trade paper back and forth to manage the chart. Real silver is being vacuumed up at higher prices. Eventually, the disconnect snaps. When COMEX runs out of metal to deliver, the spot price has to gap up to meet the shadow price. That's when you see silver jump $5 in a single morning. We're living inside that gap right now. The screen is lying. The invoice is telling the truth. Now look at the retail market, the market where you and I buy. Check major online dealers and look at premiums. Usually, when spot rises fast, premiums compress because dealers want inventory moving. But today, spot is up and premiums are up. Why? Because dealers are afraid they can't restock. They sold a coin yesterday at $63. To replace it today, they might have to pay $65 or more. So they're bleeding capital. So they widen the spread. They quote $65 plus a $10 premium, and suddenly the ask is $75. They're discouraging buying, unless you're desperate. Or they switch to pre-order. Ships in 4 weeks. And do you know what that means? It means they don't have the silver. They're taking your money now and hoping they can find metal later. You're giving them an interest-free loan. That's dangerous. If silver runs to $80 in 2 weeks, The dealer might default refund your $65 and say, "Sorry, we couldn't source it." You get depreciating cash back, and you miss the move. This retail inventory squeeze is the canary in the coal mine. When dealers stop selling, it means wholesalers stopped selling. When wholesalers stop selling, refiners stopped selling. The chain is seizing up. So if you see $65.80 on the screen, do not assume you can actually buy physical at $65.80. The real entry price for physical ownership is closer to $75 or $80 right now. The discount window is painted shut, and now we reach the ultimate force majeure risk. We talked about industry paying $70. We talked about dealers charging $80. But what about paper holders, ETF investors, unallocated account holders? They hold a contract that says, "We owe you silver." And buried in almost all of those agreements is a clause. If metal can't be delivered due to market disruption, settlement can be made in cash. We are creeping toward that trigger. If the shadow price is $70 but the paper spot is $65, banks would rather hand you $65 cash than go buy $70 silver to give you. It's cheaper to default. And if we see a wave of cash settlements, it's game over for paper pricing. Trust dies. Investors take that cash and rush into physical, driving premiums even higher. This is the doom loop for fiat pricing. Shortage creates premiums. Premiums push cash settlement. Cash settlement triggers physical panic buying. Panic buying lifts premiums again. We're in the early stage of that loop. The $65 breakout was the signal. The inability to source metal at that price is the confirmation. If you hold paper, you're betting the system holds together. If you hold physical, you're betting the system breaks. Look at today's spread. The system is already cracking. So we have the technicals. We have the bank losses. We have the physical disconnect. The math is on our side. Geology is on our side. Industry is on our side. But there is one enemy left, your own mind. The next few days will be psychological warfare. Volatility will climb. Headlines will turn scary. Banks will try to shake you out one last time before price goes to triple digits. In part 4, the conclusion, I'm going to give you the mental armor. I'm going to show you how to survive the volatility. I'm going to outline price targets for the rest of the week. And I'm going to leave you with a strategy so you don't sell your winning lottery ticket for the price of a coffee. We have reached the final chapter of this market alert. We dissected the breakout mechanics. We counted billions in bank pain. We exposed the secret $70 shadow price industry is already paying. Now we have to zoom out. It's easy to get trapped in the minute-by-minute battle staring at $65.80 and wondering what happens in the next 10 minutes. But if you do that, you miss the history being made. Today, Wednesday, December 17th, 2025 marks the end of an era. The era of cheap silver is dead. The era of managed prices is dead. We have entered the era of price discovery, and that is both terrifying and exhilarating. In price discovery, there are no maps. There are no clean resistance levels, because we're trading at numbers not seen in a generation. The market is trying to find the price that balances a massive physical deficit against exponential monetary expansion. And I'm telling you, that price is not $65. It is not $70. It is multiples of where we are now. But your biggest enemy right now isn't J.P.Morgan. It's vertigo. When an asset moves this fast, breaking old highs and entering blue sky territory, humans get dizzy. You open your portfolio and see gains that used to take years happening in days. And your brain screams, "This can't be real. It must crash. Take the money and run." The banks count on that. They rely on weak hands not because retail lacks money, but because retail lacks conviction. So expect volatility. You may see silver drop $3 in an hour, then rip up $5 the next hour. The goal is motion sickness. They want you so stressed by the swings that you sell just to sleep at night. Don't give them that satisfaction. Volatility is the price of admission for generational wealth. If you sell now at $65.80, where do you go? Back to the dollar, a currency bleeding 5% of its value a year? Back to a stock market at historic valuations? You need to understand. Silver isn't only going up. The dollar is going down. Silver is the mirror reflecting the collapse of fiat. Don't sell the lifeboat to buy a ticket back onto the Titanic. Turn off the screen. Stop staring at the 1-minute chart. Look at the weekly. Look at the monthly. The trend is vertical. Momentum is relentless. Let the market do the heavy lifting, and I hear it all the time. But $65 is expensive. People remember silver at $20 a few years ago and assume $65 must be a bubble. So, let's anchor to history. In 1980, the Hunt brothers drove silver to $50 an ounce, the old all-time high. But $1 in 1980 bought far more than $1 in 2025. Adjust that $50 for official CPI inflation, and that old high is roughly $170 today. Think about that. To merely match the purchasing power of the 1,980 high, silver would need to nearly triple from here. At $65, silver is still trading around a 60% discount to its inflation-adjusted high. Stocks are at all-time highs. Real estate is at all-time highs. Art is at all-time highs. Silver is still climbing out of a 40-year bear market. So when you feel like $65 is too high, remember you're looking at one of the most undervalued assets on the planet in purchasing power terms. We're not at the top. We're barely off the bottom. That perspective is your shield. When the media screams bubble, you look at the inflation math and smile. The bubble isn't silver. The bubble is the dollar. Now the final question. When do I sell? If we're going to $100 or $170, when do you cash out? Here's the secret of the wealthy. You don't sell for cash. Cash is a melting ice cube. You sell to swap. You exchange an overvalued asset for an undervalued one. Today, silver is undervalued. One day at $100 or $200, it may become overvalued compared to other things. So you watch ratios. Watch the gold to silver ratio. Right now it takes roughly 70 ounces of silver to buy 1 ounce of gold. Historically, that ratio averages around 40 or 50 to 1. In 1980, it hit about 17 to 1. If the ratio falls to 30 to 1, that's your signal. You swap volatile silver into stable gold. You double your gold stack without touching a dollar. Or you swap for real estate. In 1980, you could buy a median American home for roughly 800 ounces of silver. Today, at $65, it takes roughly 6,000 ounces to buy a home. Wait for that ratio to close. When you can trade a monster box of silver for a down payment on a farm, that's an exit. Don't trade for digits on a screen. Trade for acres. Trade for ounces of gold. Trade for cash flow. That's how you lock in the wealth transfer. We covered a lot today. The breakout, the gamma squeeze, the bank losses, the physical disconnect, and the psychology. Wednesday, December 17th, 2025 will be remembered as the tipping point, the day the banks lost control, the day the $65 wall fell. The genie is out of the bottle. You can't put toothpaste back in the tube. The world now knows silver is scarce. They know price was suppressed, and now they're rushing for a seat at the table. You are already seated. You saw it coming when everyone else was asleep. Now your job is simple. Don't move. Don't sell. Let the market come to you. The squeeze has only just begun. Hold fast. Subscribe.